Today, we're doing a complete breakdown of ASC 210. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying ASC, prepping for a Big Four interview, or working in finance, this is everything you need to know. Before ASC 210, the chaos of inconsistent balance sheet presentations plagued financial analysts. Imagine a $10 million liability hidden under vague categories. ASC 210 standardized the classification, bringing clarity. By the end of this section, you'll grasp how this standard transformed balance sheet presentation, making financial analysis more reliable and transparent. ASC 210 emerged to tackle the inconsistency in balance sheet classifications, where companies differed in presenting current and non-current assets. This lack of uniformity made it difficult to compare companies. The standard's focus on liquidity measurement allowed stakeholders to better understand a company's financial health. By mandating consistent presentation, ASC 210 made balance sheets more transparent, facilitating clearer financial analysis. ASC 210 is essential for all entities using US generally accepted accounting principles. Effective since December 1992, it requires companies to distinctly classify current and non-current assets and liabilities. This clarity aids in assessing liquidity, ensuring that stakeholders can accurately evaluate a company's short-term financial standing. By improving how balance sheets are presented, ASC 210 significantly enhances financial transparency and comparability across different entities. The balance sheet presentation model under ASC 210 is about clarity. By separating current from non-current items, it provides a straightforward view of liquidity and operational capacity. This separation helps investors and creditors gauge the financial health of a business. For interviews, articulating this model shows an understanding of crucial financial standards, something that differentiates candidates in discussions about financial reporting. Scope matters because it defines what ASC 210 governs. Many forget income statement presentation isn't covered, a classic trap interviewers use. Knowing these boundaries ensures accurate financial reporting and reveals strong accounting acumen. Misunderstanding could lead to misstating financial positions, impacting decisions. ASC 210 specifically addresses how to present assets, liabilities, and equity on the balance sheet. For example, it requires entities to classify items as current or non-current based on a one-year threshold. Proper disclosure under ASC 210 reveals crucial insights like liquidity and financial stability. Without this guidance, financial statements could mislead stakeholders. ASC 210 explicitly excludes income statement and cash flow statement presentation. These exclusions mean companies can't rely on ASC 210 for revenue or cash flow insights, a common interview pitfall. It also doesn't cover segment reporting, which requires separate guidance. Understanding these exclusions is crucial for those interpreting financial statements, ensuring clear comprehension of ASC 210's limits. Current assets are those expected to be turned into cash or used up within a year. Think of inventory in retail, which is sold and replenished regularly. Properly classifying these items is essential for evaluating a business's short-term liquidity. Incorrect classification can skew financial analysis, misrepresenting the company's ability to handle immediate liabilities. Understanding this definition is key to accurate financial reporting. Non-current assets, such as factory equipment or real estate, aren't expected to be liquidated within a year. They provide essential infrastructure and support for long-term operations. Depreciation of these assets directly influences earnings over time. Misclassification could lead to inaccurate representation of the firm's long-term financial strength. Correct understanding aids in strategic planning and investment decisions, ensuring resilience and growth. Consider these scenarios. A company refinances a short-term debt, extending it beyond a year. ASC 210 guides reclassification on the balance sheet. Non-operating assets typically aren't classified as current, a subtlety often missed. A significant inventory buy might not fit standard criteria for current classification due to intent or use. Assets held for sale require careful consideration, impacting presentation. Mastering these nuances can set you apart in interviews and practical applications. Ever wondered why a company's balance sheet places immense emphasis on clear categorization? ASC 210 ensures stakeholders comprehend a firm's financial positioning. Imagine a company with $10 million in ambiguous contracts. This model clarifies asset and liability classifications, enhancing transparency and decision-making. The balance sheet presentation model is crucial for categorizing a company's assets, liabilities, and equity, ensuring clarity for stakeholders. We'll walk through Meridian Corporation's $10 million SaaS contract with Acme Incorporated, demonstrating how assets and liabilities are distinguished and equity is presented, aiding transparency and financial decision-making. Identifying assets correctly impacts the balance sheet's clarity. Meridian Corporation's $8 million software license is a non-current asset, while the $2 million implementation is current due to short-term realization. Misclassification can distort liquidity and financial ratios. Accurate asset categorization per ASC is foundational for valid balance sheet presentation. Classifying liabilities accurately ensures clarity in financial obligations. Meridian Corporation's liabilities for $2 million implementation are current, while $8 million software obligations extend beyond a year, classifying as non-current. Misclassification affects liquidity perspectives. Adhering to ASC's maturity-based classification is essential for precise reporting and analysis. Equity presentation highlights ownership interests. For Meridian Corporation, the $10 million contract affects retained earnings as revenue realization enhances equity. Overlooking such impacts can distort ownership value perception. ASC ensures equity components reflect actual changes, offering a clearer view of ownership interests in the financial statements. Proper format and disclosures are paramount in balance sheets. Meridian Corporation must disclose the $10 million SaaS contract, ensuring asset and liability classifications are clear. Inadequate disclosures can lead to misinterpretation. ASC insists on clarity, ensuring stakeholders grasp financial details comprehensively, enhancing trust and compliance. The measurement method you choose directly impacts your balance sheet. A wrong choice can overstate assets by millions. ASC 210 outlines specific methods for measuring current liabilities, guiding how these should be initially recognized and disclosed. Knowing which information must be disclosed ensures that financial reports provide a true picture of a company's financial health. Understanding when and how to recognize liabilities is crucial. ASC 210 states you recognize a liability when it's probable that an outflow will occur, and you can estimate it reliably. You initially measure it at the expected settlement amount. For practical purposes, any liability exceeding $5,000 needs consideration for inclusion. This ensures precision and reliability in financial reporting. After initial recognition, liabilities must be reassessed at each reporting date under ASC 210. This review ensures that the amounts reflect current expectations and any changes are recognized in current and future periods. If the time value of money is material, discounting may be necessary. This ongoing assessment helps provide a true reflection of a company's financial obligations, safeguarding against misstatements. ASC 210 requires that liabilities be clearly presented as current liabilities on the balance sheet. Each item must be broken down with notes explaining their nature and terms. Current liabilities are those expected to settle within 12 months. Even if contingent liabilities don't meet recognition criteria, they must be disclosed in notes, ensuring transparency and aiding stakeholder analysis. 4 key disclosures under ASC 210 are essential for a clear financial picture. The nature and timing of liabilities informs stakeholders about imminent obligations. Disclosing terms and interest rates give clarity on payment expectations. Changes in estimates are crucial as they impact financial statements and reveal underlying assumptions. Finally, contingencies and uncertainties must be disclosed to inform stakeholders about potential future impacts, maintaining transparency and trust. How does a CFO handle liabilities? Imagine assessing a $200,000 liability. First, ensure it meets recognition criteria, probable and estimable. Then, disclose terms, like a 5% interest rate over 12 months. On reporting dates, reassess to adjust for new information. If there are contingent liabilities, disclose these too, as they might impact financials. This diligence keeps financial reports accurate and stakeholders informed. Meridian Corporation, a global manufacturing company, signs a 5-year operating lease for its Singapore warehouse. Watch how every accounting event plays out. The initial recording involves recognizing both a right-of-use asset and a corresponding lease liability. According to ASC 210, this reflects the present value of lease payments. The asset acknowledges the right to use the warehouse, while the liability represents the future lease commitments, balancing the balance sheet and aligning financial statements. Each lease payment reduces the lease liability and affects cash flow. ASC 210 mandates that these payments are not immediately expensed, but instead decrease the liability. This ensures that the financials accurately reflect the remaining obligation, maintaining transparency in Meridian Corporation's transactional records. Interest on the lease liability is recognized as it accrues, reflecting the cost of borrowing implicit in the lease. This is vital for depicting the true cost of the lease over time. For Meridian Corporation, recording a $5,000 interest expense ensures that profits reflect operational realities and financial obligations. Amortizing the right-of-use asset aligns with the matching principle, where lease expenses are recognized over the lease term. For Meridian Corporation, recording a $20,000 amortization ensures that the asset's value is systematically reduced, mirroring the economic benefits extracted from the warehouse usage. Lease modifications require adjustments to both the right-of-use asset and lease liability. ASC 210 dictates recalculating to reflect new terms, ensuring that financial statements accurately portray ongoing obligations. This $50,000 adjustment highlights Meridian Corporation's proactive management and flexibility in lease negotiations. Year-end adjustments are crucial for accurate financial reporting. By reducing the lease liability by $240,000, Meridian Corporation aligns its books with actual cash flows and obligations. ASC 210 ensures liabilities reflect true balances as of the reporting date, maintaining financial integrity. At the lease's end, derecognition of both liability and asset ensures that Meridian Corporation's balance sheet no longer reflects the concluded lease. This $950,000 entry clears the books, highlighting the life cycle's completion and ensuring that future financial periods start fresh, without residual lease-related balances. Every Big Four and investment bank interview on ASC 210 follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. ASC 210 governs balance sheet presentation, focusing on liquidity classification. It ensures consistent reporting of current and non-current assets and liabilities. This clarity aids stakeholders in assessing a company's financial position. A common pitfall is misclassifying items, which can obscure liquidity insights. Memorize. Always differentiate current and non-current items based on a 1-year timeframe. Under ASC 210, current items are expected to be settled within a year, while non-current items extend beyond. This distinction impacts liquidity analysis. Missteps often involve incorrect classification of liabilities due within the next operating cycle. Remember, precisely assess settlement timelines to maintain accurate reporting. Prepayments under ASC 210 are recorded as current assets if expected to be consumed within a year. The allocation helps stakeholders understand future cost impacts. A typical error is failing to adjust for the timing of expense recognition. Key takeaway: align prepayments with corresponding expense periods for accurate financial statements. Unearned revenue is classified as a current liability under ASC 210 if the service or product will be delivered within a year. This impacts liquidity assessment. A frequent mistake is neglecting to update the classification as services are rendered. Key point: review unearned revenues periodically for accurate liability portrayal. Indian accounting standard and international financial reporting standards have nuanced differences, such as Indian Accounting Standard 1's requirement for a statement of changes in equity. International Financial Reporting Standards allows more flexibility in current and non-current classifications. A common oversight is confusing these frameworks, leading to reporting errors. Focus on framework-specific presentation rules to avoid mistakes. Cash equivalents, highly liquid and convertible within 3 months, fall under current assets in ASC 210. They provide insight into immediate liquidity. Misclassifications can mislead liquidity analysis. Key understanding: ensure all cash equivalents meet short-term maturity criteria for accurate balance sheet representation. A loan due in 18 months is classified as a non-current liability under ASC 210, affecting long-term financial strategy. A common error is treating it as current due to repayment terms. Always verify maturity dates against the one-year benchmark for correct liability classification. Lease obligations are typically not included in ASC 210, but under ASC 842, impacting balance sheet presentation. This mix-up often leads to improper classification. Remember, identify applicable standards to ensure accurate reporting and avoid blending lease liabilities into ASC 210 framework. ASC 210 requires disclosures detailing items like liquidity, maturity analysis, and financial risk management. CFOs must ensure these are clear for investor confidence. A frequent error is vague disclosures, obscuring financial health. Remember, detailed notes enhance transparency and stakeholder trust. ASC 210 sets the framework for balance sheet presentation, aiming for consistency and clarity. It defines key terms like current assets, current liabilities, and working capital, focusing on the operating cycle. Understanding these definitions helps in analyzing an entity's liquidity position effectively. The standard is crucial for preparing comparable financial statements across different entities, providing a clear snapshot of financial health at the balance sheet date. The core model in ASC 210 focuses on the balance sheet structure, classifying assets and liabilities into current and non-current categories. This presentation helps in assessing liquidity and financial flexibility. The measurement rules, whether historical cost or fair value, significantly impact financial analysis. Proper classification and measurement are vital for users to understand an entity's financial health and operational efficiency, ensuring accurate disclosures and transparency. For interviews, focus on the nuances of ASC 210, like asset and liability classification, which can significantly affect financial interpretation. Be prepared to discuss the importance of clear disclosures and how they enhance transparency. Understand how ASC 210 compares with other standards, such as Indian Accounting Standard, and be ready to explain the implications for liquidity analysis, risk management, and comparability across entities. These insights demonstrate a deep grasp of financial reporting intricacies. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to Candy Mentor for more accounting and finance videos. We'll see you in the next one.